Hi, welcome to Behind the Data with me, Emma Trevor. Let's take a look at the main factors that have been driving the energy markets since our last update at the end of February. Our top three drivers behind prices this month are geopolitics, weather conditions, and EU gas storage. The first key driver is geopolitics, with price movements largely reflecting the volatility of current global conditions. Throughout March, negotiations continued amongst world leaders surrounding a peace deal between Russia and Ukraine. Optimism of progress towards a successful peace deal fluctuated on an almost daily basis, as headlines reported the latest update on discussions surrounding a 30-day ceasefire proposed by the US. Markets have been strongly influenced by this changing sentiment, resulting in increased volatility throughout the last few weeks. Building momentum behind this deal has also led to speculation of renewed gas transit through Ukraine after flows ended on the 1st of January this year. This speculation was supported by reports that European leaders were pushing EU and Ukrainian authorities to find a solution for resuming gas flows, and this led to a significant fall in prices, with the front-month gas contract reaching a near 5-month low. However, following last week's drone attack and damage to the Sudsa natural gas transmission system, the prospect of future deliveries through this route has been ruled out in the near term. In addition to ongoing negotiations to end the war in Ukraine, markets have also been driven by the barrage of US tariffs, which have heightened fears of a trade war. Introduced by President Trump with the aim of strengthening domestic industries. For example, as shown in the graph on screen, on the 10th of March, prices pushed higher following an announcement that the US would consider further significant sanctions and tariffs against Russia until a ceasefire could be agreed. Our second driver this month is weather. Temperatures throughout March in the UK fluctuated frequently, ranging from highs of 21 degrees to lows of -1.5, which is demonstrated on the graph here. While long-term forecasts remain below seasonal norms, the frequent changes and inconsistencies in these forecasts made the market even more unstable. The market was already volatile, and the unpredictable weather patterns added to this instability, making it harder to predict and manage energy prices and supply. The temperature forecast throughout colder months often result in a fall in prices due to the implied decrease in heating demand. However, low wind generation forecasts, which remained consistently below average throughout the month, limited any losses. The resulting low levels of renewable generation led to an overall tighter system and increased reliance on gas for power to an average of 47 MCM per day in comparison to 32 MCM per day in March 2024. That brings us to our third and final driver this month, EU gas storage. The impact of low renewable energy generation isn't just affecting the UK, it's also impacting many countries in continental Europe. Throughout the beginning of 2025, these regions have experienced similar weather conditions, leading to reduced renewable energy production. This, in turn, has affected EU gas storage levels, as countries relied more on gas to compensate for the shortfall in renewable energy in comparison to previous years. In March this year alone, gas stocks fell by over 4.5% compared to just 3.75% in March 2024. This accelerated withdrawal has exacerbated concerns from earlier in the year, with gas storage levels starting 2025 at 22.6% lower than the previous year. These lower storage levels have helped keep gas prices high. On the 5th of March, the European Commission released a draft proposal to extend the current 90% fill target for an additional 2 years, including provisions for increasing flexibility around gas storage targets. This saw prices fall significantly, as shown here, testing technical support levels as concern over volume needed for refilling summer months eased. Concerns have been further alleviated by consistently strong liquefied natural gas, or LNG, imports to the continent. As a result of increased withdrawals, it's forecast that we will need to see an additional 80 MCM per day of LNG in comparison to last year in order to reach the November 90% fill target, which equates to roughly 5 to 6 vessels extra per week to reach the target. So far this year, 579 vessels have arrived into Europe in comparison to 454 by the same date last year, which equates to an additional 10 arrivals per week. While concerns over current storage levels persist, these reliable import levels have provided the market with some underlying stability. And finally, looking forward, markets remain focused on progress towards a Russia-Ukraine ceasefire, with price movements and volatility still largely influenced by headline news. Optimism for a successful peace deal continues to be dampened by an acceleration in conflict, and further price drops following any positive headlines could be limited. One example is the recent attack on the Sudza natural gas transmission system, which ended the possibility of an immediate renewal of Russian gas flows through Ukraine. While LNG imports remain strong, we'll be keeping a close eye on factors that could impact this. For example, Asia is Europe's biggest competitor for LNG, accounting for 62.6% of global LNG imports so far this year. As we enter warmer months, increasing Asian temperatures could drive cooling demand, raising prices and causing European prices to increase in order to remain competitive. Thank you for your time, and I hope you found this update useful.